the S&P 500 is consolidating at all-time highs. It's struggling to continue its uptrend. And many investors right now are anticipating another drop in the stock market as we're seeing the rising number of new cases in the United States. You can see we're almost at 200,000 cases. We are at 200,000 cases per day in the US, and this is likely going to continue going up in the coming weeks. So that's exactly what we're going to discuss. We're going to talk about the short-term risk in the market from a technical standpoint, but we're also going to discuss our intermediate term outlook on the stock market and longer term outlook in terms of investing in the S&P 500. So stick around to the end of the video to get our full view of the market right now. Now we're going to first talk about the put call ratio. We talked about this on the site a couple days ago on gameoftrades.net, and you can see the put call ratio is coming down. Now, for those of you who don't know what the put call ratio is, it's a way of measuring the sentiment in the short term. We used it to pinpoint the bottom of the March crash. We used it to pinpoint the top of the June rally right here at this extreme level. And we've used it to know when to stay away from entries in the stock market, right? And I'm going to show you the comparison with the actual S&P 500. So you can see it's a pretty good indicator. The orange line is the stock market. And you can see when that put call ratio is at an extreme low, it tends to be the top of a significant move. That was the case in June. Right here, we had an extreme reading, top of the rally, extreme reading in October, top of the rally. Now, this is by no means perfect. It's an indicator like any other. And you can see throughout this entire period right here, the put call ratio actually stayed low for an extended period of time. And you saw the S&P 500 grinding up. And this is what we were saying throughout this period. It can grind up for a long time with the put call ratio low. So are we worried about the put call ratio starting to get into this zone? It is definitely something to watch, and it is definitely a risk factor. Now, if you see the put call ratio start to get closer to the bottom right here at 0.6, that would be very worrying. Right now, it's still at the top of that zone, so it's not that extreme, but it is something to watch, and it is additional risk. Now let's move on to the next point, and that is that you should click on the like button if you're so far enjoying this video. It only takes a couple of seconds, and it really helps our videos get pushed out by YouTube to a wider audience, so thank you very much for doing that. Now let's move on to the VIX. This is the second thing that we're worried about in the market. We often use the VIX to get an idea of when we're about to have a potential correction. And right now, it does look like it's setting up for a potential rise in volatility. So for those of you who don't know, when the VIX is rising, volatility increases, and you tend to have the stock market in a correction or an actual crash. Like in March, you had massive volatility and the markets were absolutely tanking. But when you have volatility decreasing, that usually means the market is going up, grinding up as volatility decreases. So what's happening right now, and you can see the comment from the post we made on gameoftrades.net, the VIX is coming down to a confluence of support. We have this channel of resistance right here and symmetrically support. So this is a significant support. It acted as support all the way through this period. Right here, it was support. Here, it was resistance. So this is an important level. It will act as support. And you also have this horizontal support right here. So that's a confluence of support. And we could see a reaction of the VIX from this point. And if we do, that would mean a small pullback in the markets, or even a larger pullback depending on which levels we break on the S&P 500. Right now, we don't expect anything major from the stock market. We're still looking for more upside. Price has a bullish structure on the S&P 500. We are still bullish. We just have some warning signs that suggest that we shouldn't be taking new entries, right? We had a beautiful entry here right after the pre-election volatility. This was the trade setup we had on the site with the bottoming price action at support and the 3 targets. Now the S&P 500 has run up It's broken that consolidation pattern, this downtrend line. You can see this downtrend line right there from these two peaks. It's broken that, back tested. That was another potential opportunity, and we've raised our stop loss. We're at break even on that, but we're not taking any additional risk. We're going to keep it safe on the S&P 500 right now. There are a couple of warning signs, so we're not going to try and rush this. The next bullish development we're looking for is a potential break of this triangle pattern here, right? That's a consolidation pattern. You have the flagpole here, a pennant kind of pattern, and then a breakout here would be extremely bullish, especially if the Nasdaq starts to catch up. I know the Nasdaq's been lagging a little bit right now, so that's bearish. You really want to see the Nasdaq 100 catching up with that breakout if that happens. So that would be a bullish development, and we'll be all over that if that happens. But until then, there are some risks to be aware of in the stock market. Now let's move on to the intermediate term. That's the most interesting part because there's a lot of things we want to cover on that. So pay attention because this is some important stuff. So from experience, and you can look all over the internet, the stock market tends to think ahead, right? It tends to price in things that have not happened yet or are not happening yet. And that can go as much as 6 months in advance, right? The stock market can start pricing in things that are very likely to happen 6 months from now. And that brings me to this chart right here. This was a chart that was posted on Twitter by Macro Charts. You can go follow their account. They have some very interesting content on there. Now, this is the daily news sentiment index. So this index measures how bullish or bearish news headlines are on the actual economy. So there's two major things to notice on this chart. And the first one is not that obvious. There is a very high correlation in these cycles between the political party of the incumbent president and how bullish or bearish the sentiment is. So we're going to take a look at that from the beginning and put arrows to define the trends. So throughout this entire period right here, we had a Republican president. So you can see it made a high right before Ronald Reagan came into office and a low right before he came out of office. The next president was, of course, Bill Clinton during the dot-com bubble. So we're going to put another arrow to identify the trend at the very beginning. Right before he came into the presidency, the news was extremely bearish. And right at the end, the news was extremely bullish. Now, throughout this entire period right here, we had George W. Bush. So again, same thing, Republican president gets into office as the news is bullish and gets out as the news is bearish. Now, next president is of course Barack Obama, who gets in as the news sentiment is extremely bearish and gets out right there in 2016 as the bullish sentiment peaks. And since then, right there, you can see that corresponds to the exact moment where Trump became president. There was a top in the bullish sentiment of the news, and we then had a major bearish trend in the news sentiment index. And you can see right now, as soon as Donald Trump is out of office and the Democratic president is back into office, we will likely get another bullish sentiment cycle right here. Now, this pattern isn't really surprising. News and media outlets do tend to lean more Democratic than Republican. So the probability of the sentiment index going up with Biden as president is very high, especially with economic recovery on the way. The vaccine will start getting distributed and hopefully the health crisis will be behind us. So this is what we expect to happen. Now, what does that mean exactly for the stock market, right? Who cares about the news sentiment index? What does it mean for the stock market? And that's the second thing to notice that's been highlighted by macro charts, and that it's coming down to this area of support, or at least this area where it usually tends to reverse. And there's been 3 times in the past where the news sentiment has been this low. We can even take this low here. So 4 times. And in each of those cases, it represented a significant bottom in the stock market, right? We can even take here in 1998, significant bottom, and that was the news cycle, the bullish news cycle that fueled the last leg up of the bubble. And we think this is exactly where we are right now. The last bullish news cycle to feed the end of the bubble. But in general, this does seem to be a pretty good contrarian indicator. It pinpointed the bottom of the 2000 crash, it pinpointed the bottom of the 2008 crash, and it kept you bullish in 2011 when the news and media were panicking. So will it be different right now? Only time will tell. But this definitely feeds into the melt up theory. In each of those cases, the news sentiment bottomed as the stock market was bottoming. That was the case here in 1991 after the bear market, in 2000 after the bear market, in 2008 after the bear market. But the sentiment never bottomed when the stock market was at all-time highs. So imagine what kind of an effect this would have on a stock market that is already at all-time highs. And let's just think about what could potentially drive this last bullish news cycle before the ultimate top of the bubble. We need to think 6 months out from now. So in 6 months, we can reasonably expect the vaccine to start being distributed, the economy to be in recovery mode, and stimulus being injected at unprecedented rates. That is what the market is expecting right now. They're not expecting an insolvency crisis. They're expecting stimulus and recovery, right? So that is what can be priced in right now. Of course, that is if nothing bad happens in between. If we have major bankruptcies before that, then the markets will start tanking because that is not expected. But as long as nothing bad happens, the markets will price in a strong recovery. So all that could be good for stocks, especially if we see the US dollar start to come down. Because if the US dollar is going down, then investors don't really have a choice. We have massive stimulus, the dollar is being devalued, and they have to transfer their investments from dollars to stocks. They don't have a choice. So that's something that we're waiting for, a confirmation of a breakdown of the dollar. If the dollar breaks this 92 support level, we're gonna likely come down and potentially revisit the 86 point zone on DXY. And that would be extremely good for stocks and extremely good for gold and silver and even cryptos. And from a technical standpoint, it does look like that's something likely to happen. We had a nice long-term uptrend line on the dollar right there, multiple reactions, and we broke it, back tested, and so far it's been reversing. So that looks like a nice setup on the dollar. And this zone is where we're going to be starting to get back into the dollar. That's where we're going to sell a little bit of our gold, a little bit of our cryptos, and start getting into the US dollar. And this zone would be extremely oversold for the dollar. There's huge support around this level. This would be a nice zone to pull back to for DXY. So as soon as that happens, investors all of a sudden are going to say, all right, the dollar is oversold. The dollar is a nice investment right now. So they're going to cash in their gains from the stock market and get back into the dollar. And that's when you'll get the dollar short squeeze that everyone's talking about. It's not going to happen just yet. We need one more leg down in the dollar before that happens. And by the way, from a technical standpoint, we're going to put up the RSI and we're going to zoom out to 2008 to see what happened. And we're looking for a very similar scenario to 2008 in terms of the technical picture. Bearish sentiment was extremely high throughout this rally here. We had a consolidation. RSI gets into oversold here. You can see the dollar bottoms once, RSI is extremely oversold, bottoms a second time at a lower low, and the RSI makes a higher low. So that's divergence, and that's a bullish setup on the dollar. You can wait for a breakout and position for the short squeeze on the dollar. That was a beautiful trade to make, and we intend on making the same one now, all right? If we have that type of a scenario, one last leg down on the dollar will create some divergence on the RSI, and that will be a bullish setup for a potential short squeeze on the dollar. And this is something that we've said for a long, long time. The crisis, the health crisis that we've had will come in two phases. The income shock is the first part, and then the insolvency crisis. So right now we're in that period. This is the period in between those two phases. This was the income shock where you had a massive liquidity crisis, big spike here on the dollar because there was a shortage of dollars. Then the Fed comes in, solves the problem, injects massive liquidity, and that's the second phase. And we're in that period between the income shock and the insolvency crisis. And we continue to believe that the insolvency crisis will come at the same time as that dollar short squeeze. And that's why we'll be getting into the dollar in this zone, potentially even at this support. We'll have to see how the technicals look. Now, this is all things that we cover in detail on the Game of Trade site through the premium videos and the market. We've had a lot of positive feedback on the site. We recently had a Tesla trade that was activated. We talked about a trade setup on a break above $460. That trade setup was activated a few days ago, and we hit that first target for a 10% profit in just a couple of days. And we've been extremely successful on Bitcoin. One of the first videos we made on the site was talking about the Bitcoin bull market. We had multiple entries on Bitcoin at the bottom of the rally, and that has so far obviously played out well for us. There's a few members on the site that sent us thank you messages for the profits that they made on Bitcoin. So go ahead and take a second to click on the link in the description below. Check out gameoftrades.net. There's a free trial for the pro version, and we're helping so many people. Now, this video was sponsored by PrimeXBT. Now listen up, because I know this is going to be something interesting to a lot of subscribers. They have a Covesting feature on their platform. So you can go on their platform and find outperforming traders and copy their trading activity. So it's really simple. It's easy to use. It makes you see different trading strategies, different portfolio diversifications. So it can be profitable, it can be educational. And by the way, if you are a trader and you've become profitable through watching our videos and the content on the website, you can go on their platform and grow a following and receive success fees from your own trading. So make sure to go check that out. It's a very interesting feature. The link is in the description below. Now, I hope you guys enjoyed this video. If you did, make sure to drop a like on this video. In the meantime, good luck on your trading.